Good afternoon or good morning to you, wherever you may be. My name is Mark Frasco. I'm the founder and president of Coact Associates. Coact is a full service business growth agency. This series is Business Builders. It's a bi monthly series designed for business leaders, business growth leaders in the B2B market space. Today, we're going to be talking about growth strategies in a bustling economy. And we're going to talk about economic cycles and the various strategies or initiatives that you can implement at those various cycles. In particular, today, most of us are pretty busy. The economy is bustling, beginning to percolate a bit, and so we're beginning to think about how can we take that and use that to our advantage. Um, Timing economic cycles, of course, is very difficult to do, and we'll talk about that a little bit, and I'll show you some data that kind of outlines that. But I think being able to anticipate one thing for sure, and that is that economic cycles do evolve and change from quarter to quarter at times, and at least every 6 to 12 months, you'll see various cycles. So I'd like to start out actually with some data and get us all, I'm not an economics guy, I'm a finance guy by training, but knowing a little bit of economics doesn't hurt. So let's dig in a little bit and see if we can't make some discoveries together. So first, just showing durable goods. I get this information from the Federal Reserve out of St. Louis. By the way, that's a free resource that's online. You can make a note. Robust economic data, number of market segments, regionally divided and organized. There are a number of reports that you can get out of the Federal Reserve out of St. Louis. They call it FRED. It's pretty useful. We use it often in our research, and we do it a lot. We use it a lot in our strategic planning. So this particular graph is on new orders, durable goods. Those are those goods that are intended to have a life of more than 3 years. So we're talking about, these are cars, these are washer and dryers, dishwashers, machinery, etc. Durable goods. You can see on this report. It had a pretty big peak in 14, and we'll see that in some of the data that 14 was a pretty good year. Most of my data is over the last 5 years. I'm trying to show a 5-year window. But you can see really from the summer of 16, we've had a pretty consistent uptick in durable goods. And when you see an uptick in durable goods, you typically are in an environment, you're in an economic cycle that has a tendency to be investing. Um, This next slide is for those of you who play in the construction industry or related to that. This is construction spending non-residential. So this would be industrial. It would also include any infrastructure work, highways, things like that. Um, you can see it's pretty unpredictable. It'll go a couple of quarters where it'll peak out at 2% change from the preceding period. 3% is a really big change, and then dips. And I think the interesting thing that as you look at this data and as maybe you do your own research in the future, just be aware of the volatility of some of this data and how useful it is. I think if you can gather 3 or 4 economic indicators that are somewhat leading indicators of what's going on in your industry, it can be very helpful to you in determining certain strategies that you can use in the market. So here we've got a little bit of volatility. And again, remember, this is a percentage change from the previous period. So in construction, it's pretty hard to sustain 2, 3, 4% growth quarter to quarter in the construction industry. This next chart, for those of you that are in the technology sector, this is a collection. I think it's over 100 technology companies. They call it San Francisco Tech Pulse, and there's an index on their revenues, and you can see the tech market is percent change month over month on the way up, but it's relatively modest if you look at the scale. But there has been a general trend upward in the technology market. Industrial production. This is a measure of production output in the United States. And again, you can see from first quarter 16, second quarter 16, pretty consistent uptick. Again, we're going from 102 to 107. So, it looks demonstrative, but, 4 or 5% growth over that period of a year and a half, 2 years or so. This measure is pretty useful to anyone who is working in the construction industry. Again, that I follow capacity utilization a lot. We do a lot of work in the architectural engineering construction industry. Typically, when you look at capacity utilization, this is the utilization of fixed assets, plants, if you will, manufacturing plants across the United States. An indicator, typically 78 to 80% utilization of capacity utilization, indicates usually expansion in manufacturing plants. So we watch this pretty closely. The average is usually between 74, 75%. You can see we've been above that for now a few years, and over the last few periods, we're starting to tick up into the high 70s with a little bit of a decline just recently, which is interesting. We'll see where that goes. It sounds like some of you might be having some problems hearing me, and I apologize for that. Continue to chat with me if it doesn't get any better. It's probably an internet issue, and if it doesn't get any better, I'll pause and jump on my phone and see if that'll help us. 4-week moving average of initial claims of unemployment. Again, the numbers 240, you can see kind of average around there, 230. You can see that the average claims are down pretty significantly over the last 4 or 5 periods. So labor is getting tight. That's going to put some pressure on those that are looking to hire people and on wages eventually, which is going to higher our cost of goods if labor is pretty important to your process. And we'll talk about that and strategies around that. The gross domestic product, this is probably one of the key leading indicators that people look at, the GDP, if you will. It's a pretty good indicator. This is real GDP, which means it's been adjusted for inflation. This is the sum of all services and products sold in the United States. And so typically, and we'll talk about this in just a second, typically you'll see in a balanced economy, you'll see 2 to 4% GDP. And we've been in that area the last couple of indicators, and we'll talk a little bit more about that. Not the best indicator really of economics or economic cycles, but the S&P 500 is something we do pay attention to and take a look at it. It is an investor's belief of the potential for, improved profits in the future. It's their, whether they're bullish or bearish, if you will, on the market in general. I like the S&P 500. It's a little bit broader scale, still very large organizations. But we've had a pretty good year up until a month or so ago. We were over 20% in the S&P 500. Again, meaning most investors anticipated that the future is going to be better than our current state or the past, and you can see the quarter returns down there. Again, if it weren't for this period over the last 30 to 45 days, we were up above 20% growth on the S&P. This next chart kind of just shows the last year to date a little bit. Sometimes we really think we've got it figured out and things are rolling. And from financial theory, we know that timing the market really doesn't work. You've learned over the years, if you've done any kind of investing, that diversification of your portfolio, leaving your portfolio in and making regular contributions or investments in your portfolio, typically outperform anybody who's trying to time the market. It's probably not that different in business strategy or market strategy for organizations. Trying to time economic cycles is pretty difficult to do, but there are some tools, and those were a few. Again, check out Fred and other resources. If you are a COAC client, some of you are that are online. We have other resources, IBIS World research tools that we can supply you that are more specific to your market. But find those tools that help you with the leading indicators of your business and where you might be going, and help you anticipate better to build the structures strategically that are going to benefit you in the future. So let's dig in a little bit. I told you that we were going to talk a little bit about real GDP again after inflation. If you look at the percentage of change by quarter this century since 2000, 68 quarters. I did some little Excel spreadsheet stuff, and these are the results you get. So the median, if you stack up all those quarters, is 2.2% GDP growth. Again, that's the percentage change from the previous quarter. So 2.2 is the median. If you take that, sort of one sigma in the middle, you've got that like the 15th percentile to the 85th percentile. So about 70% of all of those quarters are between 0.27, which is still growth, and 3.84. What that means is only about 15% of those quarters are above 3.84 percentage growth from the previous period. So it's just kind of interesting when you think about it that the fluctuations in our GDP, again, a pretty common measure for us to understand what's going on in the economy, is really doesn't vary that much, and we don't see bustling economies, quite frankly, that often. Those economies over, in this particular case, 3.84, but if you say over 4%. So we'll be using this information to kind of slice and dice, if you will, the various market or economic cycle types. Again, I'm not an economist, so I'm kind of making these pieces up, but they are going to be, I think, useful for us in strategic conversation. So, I'm paying attention to this 25th to 75th percentile. Over the last 12 quarters, ending December 2017, we've averaged 2.1% growth period to period. In the last 4 quarters, 2.5%. So while some of us might really feel like there's a lot of activity going on, the economy is starting to percolate, in fact, it's pretty average right now. We've just come out of some cycle over the last couple of years. It's been sort of down. So we have some exuberance towards that. It's a lot more fun at 2.1 and 2.5 than it is at obviously at 0.8 or 1.2. So we're feeling that lift in the economy. It's actually not quite bustling yet. Hoping we can get there. So you'll see this diagram. I put this together spatially for us to think about. There are times when the economic cycle is sort of driven by the supply side, and other times when it's driven by the demand side. And I'll explain that a little bit, at least my logic around it, to help us think about these economic cycles. So, on the far left, bottom left, we've got markets that are sort of in deep recession or depression. Doesn't happen that often. We'll talk about it. We did have this occurrence in 2008, 2009, sort of a market reset. So most market indicators actually since 2008 and 9 are showing growth. But again, that's period to period. Looking back historically, what we saw as growth was really just a re-nourishment, if you will, replenishment of many of the buying cycles that were clearly there in the late 2000s, 2008, 9, 10, pretty healthy economic cycle. So the other is, a spot where we play most of the time, 60% of the times, this balanced economy, supply and demand are pretty much in balance, which means, the competitive structures are in place. Pricing is an issue, but value add and strategic placement in the market, all the things that we do most of the time when we're operating our companies in this balanced economy. On a kind of a supply side or downside economy, my point here is to try to describe that the supply side is outstripping demand. So that just means there's a lot more supply in the system. Capacity utilization goes down. There's a lot more supply in the economy than there is demand for that supply. Of course, this is when you see price pressures and you'll see uncharacteristically, you'll see behaviors where people who typically wouldn't talk about price are doing that in a down economy, and that is really to keep their utilization up. That's to keep their systems full, and so forth. So we make decisions strategically. Again, we position our organization strategically to, I don't know about thrive, but certainly perform better in a down economy. And then we have this bustling economy that we're talking about, which again, we're not quite at yet, but anticipating that we may be soon. Demand is outstripping supply. So here we have a little bit more demand than supply can handle. Labor gets tight, prices go up to that point to where the market won't support the prices. And then, of course, we go through another cycle. So, in a down economy, prices come down. And as those prices come down, the propensity to buy goes up. And, eventually those cycles, if in a perfect world, again, without too much interruption, that's outside of the free market system, meaning government or whatever it might be, without too much disruption, those cycles tend to reach their equilibrium and get back into more of a balanced economy. So let's put that data back up there in the corner and take a look at that, and we'll use that as a reference of where we're at. And I'll begin to describe for you what I think, anyway, I've kind of organized these different economic cycles. So this deep recession or depression, the last one we really experienced was 2008, beginning of 2008, really through 2009, but we saw upticks in the latter half of 2009. But that's when we saw GDP at levels below 0.8%. Optimally, we if you read the research, most economists will say GDP, real GDP, in the percentage 2 to 4% is optimal. In that 2 to 4%, I used actually 2.2 to 3.84 just to stay with my stats. We've had 24 quarters of the 68 in that optimal level, in that sort of market equilibrium. The last 3 quarters have been in that area. And again, that's probably why we feel the way we do. We're feeling a little bit more, our client base is feeling pretty upbeat. We're getting a little bit more strategic. We're honing in on our opportunity filters. We're tightening the bolts, if you will, a little bit on some things. And I think appropriately so. Last 3 quarters, we've seen that. But, this quarter, we're not quite there yet, but we'll see where March ends up. 7 of the last 17 years, if you took the average GDP, real GDP change, 7 of the last 17 years this century have been in this balanced economy. 2013 and 14, we were all feeling pretty good. We were competing well. Things were pretty much, again, in balance. And then last year was one of those 7 years. If you go to the down economy, an economy that's performing, in my case, below 2.2%, below the median, we've had actually 34 quarters this century out of the 68 that have been in the down economy. So probably, again, why we have some exuberance right now, even though we're just really in kind of a balanced economy, is because we have spent a good amount of time in a down economy, kind of flat, below 2.2. Not necessarily declining, but not in the optimal range. So 34, the last quarter that we had in this range was the first quarter of 2017, even though 17 kind of bounced back. Again, 7 of the 17 years, this century, 2011, 12, 15, and 16. So we had 15 and 16 before this that we were kind of bouncing back. Sort of odd, but, we kind of came back from 2008, 9, 10 was, a pretty good year. And then 11, 12, we went kind of into a down economy again, where, again, we had more supply than we really had demand. This bustling economy, again, for me, I'm saying 3.84 or higher. It's happened 10 quarters out of the last 68 this century. The last quarters consecutively were second and third quarter of 2014. And as you can see, 15 and 16 had a really difficult time maintaining that growth pattern or even coming close to it, and went down below 2%. So the last time we really experienced that, it's been about almost 4 years ago, what we would consider a bustling economy. 1 in 17 years, actually, only 1 year in the century did we average above that 4% or 3.84, and that was 2003. So, what do you learn from this? Well, obviously, we go through a lot of cycles, and those cycles tend to actually vary quarter to quarter. It's really hard for consecutive quarters to sustain any sort of meaningful or optimal growth. It's very difficult to sustain quarter after quarter. And if you go through the GDP numbers, and if you do it every quarter, you'll see there's a lot of variability quarter to quarter. So again, timing is very difficult. It's very difficult to time an economy. So the best we can do is try to anticipate, best case scenario, maybe optimal, and maybe one that's not so great, and make sure that we're aligning our strategies, our structures with that and to our best thought. So strategy, again, this is nothing that any of you online don't already know, but strategy is really a high-level plan to achieve one or more goals under conditions of uncertainty. Again, that word uncertainty. And I really think it's good. And when I work with my clients anyway, I try to help them look at the most likely scenario, an optimal scenario, one that would be very positive and one that wouldn't be so positive, and trying to help them identify the risk reward of structuring and making decisions based on their prognostications, if you will. There is a lot of uncertainty when it comes to the market, and we have to think about that, and we need to think of the best case and worst case scenarios. But this really is a high-level plan, again, to achieve your goals under these uncertain conditions. Strategy is important for a number of reasons, but one is to be able to assign the resources that we have available, which are limited resources, to achieve the goals that we have. So whether it's labor or machinery or finances or plant or whatever it might be, strategy is just as important to tell us what we're not going to do as it is to tell us what we're going to do. And I think even more so in an up economy, in a bustling economy, it's really important to decide what you're not going to do. And we're going to talk about that a little bit. Strategic thinking is defined as, it's a thinking process applied by individuals in the context of achieving success. So I like to think of, when I think of strategic thinking, I think of not only the strategies, but how to operationalize those strategies, how to bring them to reality inside the organization. So it involves the generation and application of insights and then and opportunities that are intended to help create, what we're all trying to do here is to build on our core competencies, creating a competitive advantage for an organization. And I just threw a couple things at you there, those two terms, and we're going to talk a little bit about that. But core competencies are those things that your organization are very competent in, you're very good at, that is very difficult for your competition to match. Either it costs too much or they don't know how. Those are your core competencies. It could be design. It could be that you have core competencies in certain manufacturing functions. It could be in engineering. It could, whatever it might be. But those core competencies are used to you combine and align those core competencies to your competitive advantage, which is a wedge, if you will, that you kind of punch into the market that builds your competitive advantage. It helps you take a space in the market that clearly differentiates you from the competition. I mean, we all have competition, and we all get some sense of what the competition's doing, and our customers help us understand what the competition is doing. But if you've really developed a sharp competitive advantage, building on and aligning your core competencies, you should see some clear space. And if not, call me and we'll talk more deeply about it. But you should see some clear space that is your competitive advantage, your competitive, I like to think of, it's not in this presentation, I thought about putting it in, but if any of you are baseball people, I love baseball. And there's this context that I like about, Ted Williams wrote a book that I think it was The Science of Hitting years ago. If you don't know him, he was the last hitter to hit 400 in the major leagues. And Ted wrote a book, and he talked about, and he did research on the batting, the strike zone, and he depicted each spot in the strike zone. I don't remember exactly how many there were, but if you took a baseball and you put it in the strike zone, there were like 60 spots in the strike zone. And he found those spots in the strike zone where he was able to perform better at the plate than other spots. Makes sense? So he found his sweet spot, and he found that if he hit pitches that were thrown in those 6 or 8 spots in the strike zone, that he had a better chance of hitting over 400. It's the same with your competitive advantage. If you take a strike zone that is the strategic marketplace, where is your sweet spot? Where is your competitive advantage in the market? Where can you hit above average? Your competitors have a different sweet spot, and that's okay. Sometimes we let them have that spot. But I think it's really important to understand that where your strategic architecture leads you to the greatest success. So be thinking about that as we have this conversation. Be thinking about your strategic architecture, your competitive advantage. So you've been through this, but it is useful to think about your strengths, your weaknesses as an organization, and what's going on as far as threats and opportunities. Of course, for strengths and weaknesses, we largely control. If we have a weakness in our organization, for the most part, we have the ability to correct that if it hits our priority list, and we have the time and resources to be able to correct it and make it, at least neutralize it if we can, make it a strength. But the point is, when you're doing your SWOT analysis, strengths and weaknesses are largely under our control. On the other hand, those threats, the opportunities and threats, are not. They're largely beyond our control. So again, I'm helping you with these frameworks again, just to kind of carve your brain up a little bit as you're thinking, as we move into this presentation, begin to think about where you're at as an organization, where you want to go. So strengths and weaknesses, your core competencies that are combined as a competitive advantage. So obviously those would be strengths and your competitive advantage, finding that sweet spot, that strategic architecture that allows you to build a competitive advantage in the marketplace. Those things that we don't control, we don't control the economy. We don't really control competition. We can impact competition, but we certainly don't have much control over the competition. And then our suppliers. Again, we can impact suppliers. We certainly can negotiate, whether that's labor or materials or machinery or plant, whatever it is. We can negotiate, but we largely suppliers are beyond our control. So in which economic cycle, and this is a trick question, in which economic cycle would you subordinate a strength or a competitive advantage? Of course, you would never subordinate a competitive advantage or a core competency that you've developed. Applying the core competencies that you've developed over time in anticipation of changing conditions is really important. So take those things that have become your competitive advantage, and regardless of the market that you're in, be sure that you're leveraging, applying those competitive advantage. So, obviously it's a little bit different situation. Your balance sheet looks a little bit different in each one of these economic cycles if you're in a recession versus a balanced economy versus a bustling economy. But I think the point is, if you have a core competency, if you have a competitive advantage that's still useful in the market, regardless of its economic cycle, we need to drive it into that market. And we're going to talk about how to do that. So again, as long as those core competencies can be combined and aligned to sustain a competitive advantage, regardless of the economic cycle, you're not going to subordinate it. There are times, and some of you might be thinking this, when those competitive advantages that you have, the core competencies that you have, are less advantageous than in other, some cycles than they are in other cycles. That's a part of strategic thinking. But I certainly don't think that I would remove something in a particular economic cycle. Let's talk about market position a little bit. use this a lot when I work with our clients. On one axis, I think about products and services. So there's products and services that you have a great deep portfolio. You're used to supplying them. You supply them on a regular basis, existing products and services, whatever it is that you do. And then you have the ability, if you go up the continuum, if you will, to develop new products and services or supply new products and services that are somewhat related to your core competencies, that you feel you can leverage with your competitive advantage in the marketplace. So products and services, existing portfolio, and extensions of that portfolio. And then you have markets or customers, market segments, market types, customer types. You have existing customer types, market segments that you do work with, and you could eventually develop new markets or new customer types. You could do new geographies. Maybe you're not working across the United States. You could concentrically expand your geography. This would be new markets, new customers. So, thinking about the various economic cycles. So, I'm just going to think out loud. You guys can look at it and think, okay, well, if we're in a recession or we're truly in a market reset decline, probably, new markets, new products and services is somewhat unrealistic. The investment to do that, the gestation from the time of conception to marketization of that, usually isn't days or weeks. It's usually months and sometimes years. And the investment in new products and services and new markets, if you haven't started that 2 years ago, probably pretty tough to do in a deep recession or depression type. But staying there, if we were looking at the development of new products, new markets, a bustling economy is a good place to do that. Again, you could start concentrically looking at new geographies that your cost of sale doesn't go up too much. Maybe you can start maybe with new products and service in existing customers, and build that bridge out towards new customers. Or you could take your existing customers in your existing products and introduce to new customers. So, in a bustling economy, I look at that as a little bit more of an investing economy with new products or new markets, new customer types, and we'll talk a little bit more deeply about that. But that's the time probably. I always say the best time to grow your business, meaning strategically improve your footprint, maybe increasing on your competitive advantage. The best time to do that is when you don't need to. When you get into a recession or a depression and you really need new markets or you need new products and services because the ones that you're supplying are not resonating in the market, it's almost too late by the time you get there. So a bustling economy is where you might invest in those areas. Balanced economies where, you've got equilibrium of supply and demand. Pricing is sort of normal. Labor is sort of normal. You're sort of moving along. You could absolutely look at diversification of your client base. Some of you may have 3 or 4 clients that make up 60, 70, 80% of your business. That's pretty tough. And when the economy goes down, it's really hard for you to diversify your client base because everybody's so price sensitive. That even those that you get to diversify your client base aren't going to make a big enough impact on your top line or your bottom line to make a difference. So in those balanced economies, I'm looking at opportunities to diversify my portfolio and do a little bit better job of market position and build that market position. Next, let's talk about portfolio, your portfolio of clients. If you were to stack up, this right pyramid, the number of customers, if you were to stack up your A's, B's, and C's, however you decide to do that, most would do it either by revenue or by profit per client. If you were to stack them up, of course, the number of A's that you have are typically lower than the number of C's, and we'll talk about that. And the value of each customer is greater for the A's than it is for the C's. And again, if we were to bring our graph back up and take a look at these economic cycles. So typically in a down economy or recession depression economy, we tend to, again, there's price pressure, there's more supply than there is demand. And so, there's price pressures, down economy. We tend to take on business that we typically wouldn't take on. It's either not necessarily a strategic fit for us, or it kind of, through price pressures, we take it on. We're trying to optimize our utilization. We're trying to use the fixed expense that we have to its best benefit, and we are trying to find that business. So we oftentimes in down economies aren't as strategic as we should be, but we're trying to fill the bucket. And so we'll take on some Bs and we take on some Cs. And many of us have done that over the last couple cycles. Again, the value of those is not that great, but it helps us accomplish what we need to accomplish. Now, in a bustling economy, or one that's maybe balanced but on the top side of that 3 or 4%, my proposal is to begin to prune your customer base, begin to upgrade your portfolio. Your business development and marketing efforts in a bustling economy should become, I think, more targeted to A's. Your competitive advantage should penetrate more deeply into those that are a strategic fit for you at the A level. Oftentimes we'll say, well, we're too busy to do this. We're too busy for new business. We're too busy to continue to search for new work. I would say in this particular case, and we'll talk about next, but the next thing about pricing, but I would say in that case, you're probably doing work with too many B's and C's. So get your work completed and pursue the A's that are a tighter strategic fit and presumably going to be more strategic to you in the future and a better return on your asset in the future. So if you feel like you're really busy, take a look at your portfolio and look at the B's and C's and be thinking about pruning that portfolio to improve it in a bustling economy. Let's talk about return on assets, again, in the various economic cycles. Sales versus cost of goods sold. DuPont explosive salesman Donaldson Brown actually in 1912 developed this the DuPont model, if you will, which we use now for ROI and ROA, but was really not intended for the way he intended its use. But it's useful for us when we're thinking strategically and when we're making decisions about strategy. So obviously, we're looking at sales minus cost of goods, gross margin. That gross margin minus total expenses and income taxes equals net profit. Divided by sales gives us net profit percentage. So, we've all kind of seen this calculation to return of assets. And, I think if you're a business leader, business growth leader in your organization, you got to be thinking about this all the time. You got to be thinking about the cost of goods sold, what you need to sell at. If you're selling your units of measure, some of you have contracts that are a year long, 2 years long, and I understand that. I'm not talking about those. But in new contracts that you're looking at today and they're in your core competency, these are products and services you sell with existing clients that know, your client base or market segments. You need to be getting more for what it is that you do in the marketplace. Your cost of goods in a growing economy are going up. Labor's going up. The cost of materials is going up. So we all know there's price pressures in the cost of goods sold. You've got to get more on the sales side for what you do. The only way you do that, you have to upgrade that portfolio. You've got to be working with those people that value what it is that you do. They understand how you're differentiated and what your true competitive advantage is, what your total cost of sell is, and what their total cost of acquisition and life cycle is. So all of these things come into play. You got to start thinking over the next 3-6 months, if we continue to see this 3%, 4% GDP growth, you got to be thinking about getting more for what it is that you're selling, adding value to get more. So again, looking at this model, in a down economy, cost of goods goes down, labor, cost of materials goes down until there's some equilibrium. You lower your prices. I know we hate to do it. We do business with some people that buy on price that we typically wouldn't work with. They become B's and C's in our systems. Again, in the bustling economy, we're raising our portfolio. Prices of cost of goods are going up. We need to raise our revenue numbers, sales numbers. We need to get more strategic with those people who will pay those prices. And that means we need to be pursuing them strategically, making friends with them, and managing those relationships at higher levels. So, return on assets. Again, depending on the economy that you're in, where you think we're going over the next 6 months, this should help you think about what are the strategies going into this, what we think is a growing economy. Let's talk a little bit now about market share. I've had a conversation. We've been with a client for 14 years that's a consulting engineering firm, and they have various market segments that are supported. And we had a conversation several years ago where I'm just making this up, but the glass group, for instance, grew 6%. And there were celebrations in the organization and awards being paid to the glass group, while the food group only grew 2%. And there were, deep stares at the food group for the 2% growth. But I think what's important to understand as a business growth leader and as a business leader is that in this particular scenario, let's say, and this is what we talked about that year, the glass market grew at 8%. So in fact, the glass group, who was being celebrated and paying rewards to, had lost market share. The food market had declined 2%, but the food group in this particular company had grown 2%. So they actually outperformed the glass group, but didn't receive the rewards. So the point of this conversation is you need to have some objective data about where you're at and where the market is. We use IBIS World as a tool. Any of you who are clients, if you want access, it's 300 and something SIC codes that are covered. This one happens to be point of sale software. Some of you that are out there in the technology sector, very hot sector. You can see a little bit on the graph, like 13, if you follow the red line. We're talking about, 20, 30, 40% growth, percent change over the previous periods. Now, you see decline in growth. That's not necessarily, they're not declining, they're growing, but they're only growing at 10% the last year instead of 30 or 40%. So if you were growing at 15 or 20% and that seemed exciting and you couldn't keep up with it and you were rewarding yourself, you were losing market share through 11 and 12 and 13. So I think it's really important for you to understand objective data, look at it over cycles, look at it over the next, it gets pretty hard to predict more than 5 years, but IBIS does, they look out 5-6 years. You can see that they're still projecting 5% growth in the sector over the next years until 2022. So anyways, have objective data to understand your market share. Now, I don't think that there's ever a time to accept a loss in market share. So when we think about economic cycles, I think regardless of the cycle that you're in, you want to outperform that economic cycle. You want to outperform the market. You outperform the market, again, by continuing, developing, building on your core competencies and aligning those as your competitive advantage in the marketplace. Again, regardless of the economic cycle that you're in, whether it's a bustling, growing economy or a down economy, sharpen your core competencies, penetrate the market with them, and outperform the market at every stage. If the market's growing at 6 or 7% and you're growing at 4 or 5, need to be careful that you not celebrate that and you not rest on that. There are costs to sometimes catch up with that market share. But I think it's in most cases, there are a few of us online here that wouldn't accept the cost to grow our footprint, to grow our markets. There are some cases where that's difficult, where really sophisticated CFO types are sitting and looking at, the opportunity costs associated with certain investments. But in general, you should be gaining market share, whether we have a balanced economy, bustling, down economy, and even a recession. You need to outperform your markets. And again, I think you do that by continually developing your core competencies, aligning those into a competitive advantage and using those to improve your position in the market for the next downturn. I mean, you don't know when that's going to be. So a bustling economy is not a time to relax. A bustling economy is a time to push on the metal, to really make it happen in your market. This is the time to prepare your organization for future softer spots in balanced or down economies. So in sort of a summary, I think in these economic cycles, and when we think about a bustling economy, learn to leverage those core competencies to anticipate changing conditions. Improve your competitive advantage regardless of what economic cycle that you're in. So continue to do the things that have made you successful. Keep working on that kind of purpose-driven competitive advantage that you have in the market, regardless of the cycle, and learn how to leverage that in the market, sharpen it. Position your organization in the market, protecting and investing as conditions change. So in some cases, you are protecting. You're protecting your position and building on it the best you can. And I think in other conditions, in a bustling economy or even a balanced economy that's teetering at 3 or 4% GDP, I really think you should be thinking about investing. Should we be geographically expanding? Should we be taking new products and services into the market and sort of vertically integrating? Can we be doing things in different market segments than we've worked in the past? This is a time, again, the best time to grow your business, the best time to strategically position your organization is when you don't need to. And that is a time when you're growing, when you have presumably been able to adjust your prices to the cost of goods, and that you're maintaining your margins, you're improving your market position and your market share, and you can begin to expand and make investment. Strategically upgrade your customer portfolio. During a bustling economy, this is the time to be looking at your stack up, if you will, of your customer portfolio. Look at your A's, look at your B's, look at your C's, however you evaluate that. I like to think, I certainly look at revenue, but I like to look at margin. And we in an organization that I managed years ago, an industrial distributor, we made something called a hassle factor. And some customers, it doesn't show up on the profit and loss statement, but they're just more difficult to manage than others. They take more attention away, and it's hard to show that on the P&L. But you should be able to go down that list, set up as much as you can some objective criteria, the characteristics or traits of an A, a B, and a C, and begin to strategically position yourself to be more successful with A's in a bustling economy and to prune your B's and C's. You're going to make more money, your people are going to be happier, and you're going to be in a better position strategically for the next downturn in the economy. Think about pricing strategy and improving your margins. In a bustling economy, at the beginning of a bustling economy, you certainly have some opportunities to improve your return on assets. Remember, there's more demand in the market than there is supply. Prices are inching up, and quality buyers are looking for quality suppliers. Just like price buyers in down economies are looking for price sellers. So in an up economy, as prices go up, buying systems are looking for quality suppliers. And they are still looking for competitive prices. That never changes, but those prices are inching up and they know it. So they are still trying to get everything they can for as little as they can pay for it, but they are willing to pay more because the market's getting tight. And they also know that those B and C suppliers are not going to be able to supply in a bustling economy. And one thing I didn't mention, but in the down economies, we used to talk about this all the time, or even some slow balanced economies, they're great scrubbers of the market, meaning the competition gets scrubbed. Many of them lose their shine, if you will. Some of them don't make it. And buying systems know this. And they also know that as the economy begins to percolate back up, that they're going to have to pay more for what it is they do and what they need. So I hope this piece was sort of useful, summarizing. Learn to leverage your core competencies. Position your organization in the market to make sure you maintain and invest in your market share. Upgrade your customer portfolio in a bustling economy, and think about pricing strategy and improve. If you're too busy, increase your prices. It'll slow you down. But you don't increase your prices just to increase them. You increase your prices because you can, and you could do the work for that money. So if you're too busy, those are the kind of things that you can be thinking about. Be aware of below average growth. Think about market share and how you're playing in even a growing economy. If the economy is growing 6, 8% and you're growing 4 or 5, that's great, but it's not good. You'll want to make sure that you're maintaining your market share. So thank you very much for joining me. I hope that you found some piece of this useful today. I think thinking about economic cycles, the sort of variability in them, and being able to anticipate them, find the leading indicators that will help you in your business, and making, as you can, better decisions on positioning your organization's core competencies and competitive advantage in the marketplace. I hope you'll think about joining me on May 8th, Tuesday. I'm going to be talking about identifying your driving force. This work is from Michael Robert, Strategy Pure and Simple. Every organization has a driving force that kind of helps them develop their competitive advantage in the marketplace. And I'm going to talk about that in May. Until then, again, thank you for joining me. If there's anything that we can do for you that we're not doing today, if you're a client of ours, please let us know. Thank you and have a good day.